Hello and welcome to BQ Prime's earnings conversation with Metro Brands, and I'm joined by the group's CEO Nissan Joseph to walk us through the company's first quarter earnings and also share his guidance for the quarters ahead. Good morning and thank you, Mr. Joseph, for taking the time.
Thank you, Cesar. Good to be here.
So let's quickly look at the June quarter numbers. Your revenues were up 15% at 583 crore. However, it was lower than the Bloomberg estimate. Profit dropped 12%, while EBITDA grew marginally by 2%. The growth in margins was also slowed. It came at 32% versus 36% last year. Mr. Joseph, I would like to know what stood out for you during the quarter. This was the first normalized quarter for the retail business.
Yeah, so there's a couple of things I want to speak to, Cesar. First of all is that you're looking at consolidated numbers, which is not a bad thing to look at, but it also has our new acquisition, Cravatex, in it. I would like to really peel that out and look at standalone numbers for Metro, because that gives you a truer picture and a comparison to last year without the consolidated numbers. On that truer number, we were up 12% in sales. Our profits was up 3% and our EBITDA was up 7.5%, right? So from that standpoint, it was very good. Now, you would normally think that's not the normal performance of Metro Brands, and you're right. But last year, we went up against some unusual things, right? So it was the first quarter with no COVID interruptions at all. It was also when we had pent-up buying and wardrobe refreshes going on. We also had an unusually high number of wedding days that fell into Q1. All of those things were somewhat absent this year, right? And given that it was all absent this year, so that's number one from a things that push up demand side. On the other hand, last year this time we were still wearing masks to restaurants on airplanes, so people weren't feeling as free to travel. Today we're all as free as a bird traveling around and going out to eat, and so there is a lot more ways to spend the discretionary rupee in your wallet, right? Given both those factors, I'm actually quite pleased with the performance of the team that we've landed with a 12% growth year on year. So we're in the same zip code as we were last year, which is amazing. That it's like going against Diwali and making those numbers without Diwali. So from a retail perspective, those numbers are actually much stronger. To talk about the demand a little bit more deeply, we saw sales of products over 3,000 rupees grow from 44% of our business to 49% of our business. So again, we've always tried to position ourselves to cater to an affordable premium segment. And we're glad that we are seeing that growth in that specific segment. So, overall, I'm quite pleased with the quarter. And you're right, it's a normalized quarter. On the flip side of revenue on normalization, we're also having normalization on the expense side, right? So all our COVID rent waivers are now over. We're not getting any more rent waivers on COVID. Our team is traveling quite heavily. In the normal and customary business expenses of travel to store visits, regional meetings, vendor meetings. Also, we have a lot of headcount replacement that we're kind of held off and staggered on. So on the expense side is also normal. So, I think it's the great news is I think retail is back to normal. I think it's indicative that we had a 35% EBIT, which is what we always guide to. Our path was, north of 17%, which we guide to 15 to 17%. So when you look at the vectors of the metrics of the business, it's an extremely good quarter for us, and I'm actually quite pleased with it.
Okay, so as we speak, has the demand really picked up, or is it continued to be on the slow lane? What are you seeing?
So, there's two ways to measure this. I can look against last year, and last year, as I mentioned, was just this consolidated buying of pent-up buying and things like that. But when I look over the pre-COVID numbers, right, we were up 83% over our pre-COVID numbers. Now, that's an amazing number for any retailer to talk about. I continue to believe that number will still continue to hold true as we move forward into this quarter. But when you look at it on a comparable basis, it won't be as exciting and sexy because, we are going against, even this quarter last year, we still had some of that, spillover effect of having all the pent-up buying, wardrobe refreshes, whatever you want to call it, but we benefited from it and we took advantage of it last year, and that's why we had such a great Q1 and Q2 last year as well. Having said that, I strongly believe in the position of Metro Brands and how we positioned our product, our consumers, our stores, that we will continue to, make our performance numbers of, 35% plus EBITDA CAC north of 15 to 17%.
Okay, and in terms of margins, what would be the sustainable margins going forward? Because costs have also come down a little bit, and I am guessing you would also spend a lot in the advertising and promotions, given that the festive season that you usually do. So, in terms of that, like, what would be the guidance?
Correct. So in the last quarter, our standalone margin was right at about almost 60%, right? And but we guide to 55 to 57% in margin, say so, because we have two quarters, namely Q2 and Q4, where we have all our EOSS end of season sales to get rid of our product that hasn't sold or starting to age, because we don't like to keep aged products around in our stores. That tends to normalize it back to about the 57% range. So I feel good about us maintaining our gross margin. Costs have come down, but when costs come down, we actually pass on some of that to the consumer, just like we do when costs go up. We pass that on to the consumer as well.
Okay, so how much price cuts can we expect in the quarters ahead?
Yeah, in the shoe business, it's a little bit harder to quantify price cuts to a consumer because it's not like we sell the same item every single year. There's always iterations to it. Some iterations mean the costs go up. Some iterations means you've been able to take some cost out of the product. So it's not a standard fixture of, these 5 biscuits are going to cost you 25 rupees this year. They're going to cost you 22 rupees next year. So it's a little hard to do that comparison. But overall, we are seeing some raw material prices coming down. And raw material is only a part of the cost factor of a shoe. It's not everything in a shoe, right? We also have the BIS coming up, that we're looking towards and seeing that starts at the 1st of January. And all of those things coupled in, you'll have the effect of the price, raw material decreases. You might have a few additional costs with BIS. These are all factors that we've got to look at, and we're constantly evaluating our pricing, our costing to ensure that we hit our margins.
Right. Mr. Joseph, the e-commerce segment has registered its highest quarterly sales with 53% growth over last year. So do you expect this kind of sales to continue going forward?
Yeah, I think, e-commerce, like everything, like even brick and mortar, is going to blip up and it's going to blip down a little bit. The consumer is going to continue to get more digitally oriented and digitally savvy. So that's a given. And it's not a question of, do I ever see that weaning off or growing, not happening? It'll definitely continue to happen. Having said that, though, in the shoe business, what we've noticed is consumers disproportionately like to shop stores, simply because, the tolerance of a shoe fit is not very forgiving. You can wear a shirt a little bit loose. You cannot wear a shoe a little bit tight or a little bit loose. It will hurt you, right? So having said that, I think there is a need for them to ensure that the size is right. Not that they can't return products online, but sometimes people just don't want to go through all that hassle of buying it and then returning it and then have it shipped again. Having said that, however, Sessa, we are continue to distort our investments into digital, simply because we believe that more and more consumers are going to start their journey on digital and then come to the offline store once they've identified or narrowed down what they might be looking for. So I fully expect some of those customers that are buying repeat items to say, what, I can buy this just as easily online because I know my size. And that's where some of the growth is coming from. As a percent of business, I don't see that percent drastically moving from where it is today, but it'll continue to grow with the rest of the business.
Okay, but will you also focus on the D2C e-commerce website, or will it be, the other e-commerce sites like Amazon, Myntra, etc.?
Yeah, so our e-commerce is broken into 3 distinct groups. Stuff that we sell to the marketplaces that they sell themselves. Stuff that we put on the marketplaces through which is an omni-channel market, and then of course our own DTC site, right? The goal is to drive our DTC business, but as you know, in India, the consumer is quite adept at and hooked up to one of the portals, whether it's the Myntras or the Amazons of the world, right? So the eyeballs that those kind of marketplace portals get are significantly greater than what your own D2C portal would get. And for you to drag that eyeball off that marketplace portal and drag it over to your DTC site is quite expensive. It's quite an expensive task. Not saying it cannot be done if you're able to create a user experience and a user journey that's truly remarkable, which we continue to strive to do. But having said that, we will continue to invest in driving our own D2C sites, but we also understand that the landscape in India is that they look to the marketplaces first for they can buy it easier. Having said that, though, what we do not play in the marketplace, in the e-commerce space, is in the discount game, right? We don't believe that e-commerce is a discount channel for us. Not saying we don't have things on discount online because they play end of season, we want to close it out, but that's not the predominant thrust of our business into the e-commerce world.
Got it. And what are your plans for the store expansion for the year?
Yeah, so we had guided that we would open up 200 stores in 2 years, which actually we had upped, Sesa, when we first came out public. We said in 3.5 years, we would open 260 stores. Now we're saying in the next 2 years, we'll open 200. So we accelerated that rate of store opening. Last quarter, we opened a net of 27 stores. So that, definitely, if you do the math, in 4 quarters, that puts us well over 100 for this year, and then will put us well over 100 for next year as well. I feel very confident about our ability to hit the new store targets, not because, the math works, but because the opportunity in India is tremendous. There's a lot of cities that we're not in today. We're only in about 180 cities in India. That's hard to believe when there's so many other cities we could be in. And we've mapped out, 50 to 100 cities that we can be in. We can also go and backfill with some of our other banners. If I have a Mochi in one city, I can go back and backfill it with a Metro. I can backfill it with potentially a Crocs or a FitFlop. That's the second thing. So there are many, many growth strategies that we have that we can continue. And India is so full of opportunity to grow that I think that combination of the two pretty much ensures that we will hit our target of 200 stores in the next 2 years.
Right. So you've mentioned about store additions. You've also mentioned about investments in the digital space, right? So can you give us a sense of what is the kind of investments that we can expect during the course of the year?
Yeah, so we typically spend about 3% of our top line sales on advertising and marketing. In that space, almost 80% of it is about brand enhancements. It's not shouting out sale, or it's not shouting. 80% of it is about brand building communications, and in that I would say we're digital first. We're not digital only. India still is a billboard country in the smaller tier 2s and tier 3 towns. It still has a newspaper effect in some markets. So we're cognizant of that. So, and hence we're not a digital only strategy, but it's definitely a digital first strategy. So that gives you kind of a range. We do over 2,000 crores in revenue. So that should give you about a range of, what our expenses, what our investments look like in marketing.
Absolutely, got that. So, there is a lot of competition in the market. So I would like to know, what are the strategies you would like to focus on in order to stay ahead of the curve going ahead?
Yeah, so I think the fundamental thing that drives Metro is 3 things. So we have deep operational rigor. We're not looking over our shoulders at somebody else, and we're not looking across the hall at somebody else. We're ensuring that our operations are as good as they can be. And believe me, in retail, there's always room to improve that, right? The second thing is, we're very, very financially disciplined. We're not narcissistic. We don't have egos to deal with inside the building. If a decision is a good decision, we'll make it. If it's not financially good, we will not make it, regardless of if the store is very, very, ego building to have a store in a certain location. We'd rather not do it if it doesn't make financial sense. And the third thing, and I think the underlying both those things of operational rigor and financial discipline, is customer backwards. We look at everything from the customer backward lens, right? And it's not us pushing things out to a customer. It's what does the customer want? What's their journey look like in stores? So we're all about how do we fill that customer journey in our stores, which is why if you look at the selection inside a Metro or a Mochi, it's more than just slippers or sandals or dress shoes or party shoes. It's also athletic and casuals and homeware shoes, right? Because we understand that's what the consumer wants to buy in our stores, right? So everything we do is consumer backwards. If you're focused on your consumer, you don't have to focus or worry about your competition. And what we found is the consumer likes premium products, likes great service, likes quality products. And if you can deliver that every single time, you're going to be able to sustain a business.
Okay, so within the product categories, any particular segment that is doing exceptionally well?
Yeah, I think when this wedding season, our party shoes and wedding shoes do extremely well. We continue to see growth into more of the casual segment. So I think all of us have taken the pandemic lesson of, wearing casual shoes back to the offices with us, assuming we've gone back to the office, right? So I think we've seen that trend. I also think the trend and the shift towards health and wellness being very, very important for people, especially post-COVID, has started to reflect itself in our sales of our athletic footwear. And hence, we were keen on doing the Fila acquisition because when we look to the future, we see sports as having a big opportunity for growth in India. So we've seen that stick as well. We haven't seen the fall off on homeware as much as we thought we would. You know, the slippers and the slides that people wear for comfort shoes when you're on a Zoom. I think people wore shorts and slippers most of the time on Zoom, regardless of what they wore on top. So we haven't seen that slide off as much, and that's been nice. And that's how we've been able to layer growth on growth, right? So
okay. And going into the festive season, can we expect what kind of strategies you would like to take in order to show your volumes?
Well, I think our strategy has always been to give the customer a wide selection of shoes. There's a lot of people will tell you that, if you just focus in on your top X amount of shoes, you can do it a lot better. And we understand that, but we also know that India is so regionalized as a country that even for the festival season, the tastes of the North differ from the East, differ from the South, right? And, so we're very, very cognizant of that. And, we understand that Diwali has a different meaning in the South than Onam. And these are all critical things to understand and how you can capitalize, both from a design standpoint and aesthetic standpoint, but also from a timing standpoint, right? Onam is way before Diwali. So it's not just about a festive season in India, Cesar. It is about multiple festive seasons, multiple geographies with multiple different tastes.
All right, Mr. Joseph, thank you so much for your time. It was a pleasure talking to you as always.
Thank you. Nice meeting you, Cesar.